What's up, everybody? It's the Digital World Podcast, and we're back at it today. We see that the 30-year Treasury bond is at 4.89, and so it's come slightly down from last Monday, where it was at 4.94. Again, we're not going tit for tat um, on what it does, intraday, but I do provide updates, right? Because I want you guys to see that whenever my whole point is, for those of you who are new and joining, is that we have created a new trend, and so we're entering a bear market for bonds. Recently, the Treasury just bought 4 billion dollars worth of their own debt, which I'd have to see what the breakdown was, but apparently that was like a record. Um, and so we're entering into a bear market when it comes to bonds. And there's a lot of talk about stable coins and the next iteration of the US dollar, right, would be stable coins. And what you notice is that it's almost so you have the original, which would be gold, right? The original money. Then, in order to create like a derivative of that, right? So you don't have limits, because when you're on a gold standard, gold is limited. The supply of gold is finite. Um, and so when you have a finite supply, you don't have an infinite amount of spending capability. You're limited to the amount of money that you have, right? Now, when you create a derivative of that, hence, the dollar, right? Like cash, that allows for you to, hey, you can say, I have this much gold, and I'm gonna spend. There's really no limit onto how much paper currency you can issue. Now, I think that going to um, stablecoins or digital currencies creates that other tier of derivative, and that backing that currency would now be the cash. And so I think this is a very interesting thought experiment, right? Of like what happens if you're moving to this new derivative of currency, right? Um, and that's potentially where we're going. And where I was going with that is, what if that's what's going to be used to um, buy these treasury bonds? What does that do? How does that help the U.S. Treasury? How does it help the debt markets? How does that um, save a crumbling, inefficient system? Although it's the best one we have out there and the ones that is most widely used and transacted with, the U.S. dollar, that is. How would going to that type of system help maintain the U.S. dollar's sovereignty? That's a good question, right? And so I think um, when we look at this and we're entering a time period of increasing volatility, I think my thesis is we're gonna keep going higher, rates will jump, borrowing costs will get expensive, more volatile events. You're gonna see a lot more finger pointing. Oh, like because of this, we are going to. We're suffering bad because of like some natural event or some um, geopolitical event, right? There's going to be a lot of that I foresee coming in the future. And there's the saying that says, show me the chart and I'll tell you the news. And it's like, well, I'm showing you the chart and I'm telling you what's coming. I know right now, 30-year mortgage rates have not changed since the last time we put out a video. And so that still is maintaining itself. However, when we go to the probabilities for rate cut, last time we made a video, it was around 90 something percent, like 98%. It has dropped to 75.5% that there's going to be a rate cut. There's a 24% chance that it'll maintain itself. So those odds have definitely dropped. And that's interesting because last time I showed you Germany's 10-year note, right? Or I believe it's bond. Um, went has gone up, and so they've cut multiple times. So um, the inflation risk outweighs the recessionary risks, right? Um, and when we see here Japan's 20-year bond yield, I want you to look at this closely. So they peaked, or they bottomed, sorry, in 2016, and they've kind of meandered, right? Meandered for about a good 6 years, and then it started taking off. Okay, and now it's the highest level since, let's see, 1999, probably 1998. So it's been 27 years about since we've seen these levels on the 20-year bond yield for Japan. And so when I look at that, and then I look at this, we've had 5 years of this. When does this start making major moves to the upside? Again, I'm not saying it's going to go from 4.89 to like 10%. No, it doesn't work like that. Uh, but it can go from 4.89 to 5, and from 5 to 5.1, right? Like it's these bond markets don't move in major in major like ways, right? But when it does move, and you see those like 10 basis point moves, like that's pretty significant, right? And so for me, it's this level that's been held since 2000, even further back, right? You can even go back to 2002. So you have this level here, and I think it will be pretty significant if it keeps climbing up to towards 5 and higher than 5. So that's something worth monitoring and seeing where that will go. Um, but I think these rate cuts, you'll see mortgage rates have reacted, right, on the news. It hasn't even happened. That's the credible threat that there could be interest rate cuts. And you've seen mortgage rates go lower simply on that fact. When we actually get to the actual rate cut in about a month, we'll see um, it's not going to go any lower because it's already been priced in. And we've gone from it was around 6.74, 75, around that area. It's almost pretty much factored in a quarter point cut. And so what we'll see is, will this skyrocket up on the actual cut? Because, if we look at the last time the Fed cut around this time period, look at that. We were soaring, right? We soared quite a bit, almost 3/4 basis points, or sorry, 75 basis points. So 0.75%. So we'll stay tuned. We'll be watching, but folks, I don't anticipate in the future that your borrowing costs will get cheaper, unless there is you know, something drastic happening. I mean, when I look at this chart, it doesn't indicate to me that we're going lower. So, anyways, um, what's the housing market looking in your area? Are you guys seeing any slowdowns on home sales? I know the season right now, currently as it stands, since we're going into the winter time, it starts to slow down, um, and it's been a pretty slow summer. So it's the changing of the winds, and I think come next summer and spring, people who couldn't sell their house during this time period will see significant price drops for their homes. And so, um, if they want to get ahead of the curve come spring, they'll probably want to put out some competitive pricing in order to get their house sold, whether if it's out of desperation or whatnot. I think you're going to see a lot of those prices coming. So, anyways, Thank you for watching. Like and subscribe to the channel. This is the Digital World Podcast, and I'll see you in the next episode.